JPMorgan's chief U.S. economist Mike Feroli is with us on this Tuesday. Mike, great to see you again. Good morning.
Good to see you.
I loved the title of your report coming out of off the jobs number called Just What the Doctor Ordered. You say at the end of the day, the data is going to call the shots, and the data say we are done with rate hikes. You're pretty happy with a 1.5 number for Q4. Can you just talk about where you think we are at this moment?
So, I think the economy is slowing. I think the GDP numbers have been quite choppy in this cycle. I think if you look at the payroll growth numbers or the hours worked numbers, I think that gives you a more faithful representation of the economy, which is that we are gradually slowing as we go toward the end of the year. We do think we maintain positive growth next year, so we're not in the recession camp, but certainly you highlighted some of the risks there with issues around the banking sector a few moments ago. But we do think, we're slowing, and that the Q3 bounce in GDP, which was really quite impressive, was a bit aberrational as well.
How do we take what you're saying and then what we're also hearing from other corners of, say, JPMorgan about the risk of higher for longer, the boiling the frog scenario, things start to break, credit events happen, income, excess savings at the low end it deteriorates completely, things like that?
Yeah, so I guess we are in the higher for longer camp. I mean, we're not looking for a cut until the third quarter of next year, which would be a little bit on the longer end as far as these things go. And certainly in the meantime, we cannot rule out that the events that we saw in March are completely behind us. So we are cognizant here that even while we're looking for a soft landing, and so far we've had a pretty immaculate disinflation, that going forward, we might not be as lucky as we have been this year with the combination of really strong growth and, as Austin Goolsbee mentioned, a pretty historic drop in core inflation. So we've been pretty lucky this year, but I wouldn't take that to the bank for next year.
Which is the bigger risk, Mike, next year, that inflation doesn't come down to target or that the economy falls out of bed?
I would probably tilt a little bit toward the economy weakening and a modest contraction occurring. Look, I think inflation, you mentioned core PCE 3.7 on a year-ago basis, but on a 3 and 6 month annualized basis, we're running below 3%, right? So I think we're making some pretty good progress. Maybe getting all the way down to 2% may take some time, but I think if we're in the two handles, I don't think most people are going to be too unhappy with that. But certainly, we are a little concerned here that the lagged effect of monetary policy may start to bite a little more next year at a time when, you talked earlier about the fiscal situation. This year was a really big year of deficits. Next year might be slightly less accommodative when it comes to the deficit. And so that could be another modest headwind, along with the banking stresses that we mentioned earlier.
Although I wonder, going into an election year, how serious you expect the fiscal conversation to get. I mean, are politicians going to be looking to offer solutions on the savings side, or is that not going to be politically saleable? There have been some comments from the street last couple of weeks that maybe the easiest thing to do is just to raise taxes on corporates.
So I really, I look at D.C. right now. I don't see much of a common vocabulary when it comes to addressing the deficit. So I think really the only thing we can expect is that the Fiscal Responsibility Act, which was passed in the early summer or late spring, I guess, will kick in early next year and reduce spending or cap spending. And that will give you some modest degree of restraint on spending. But I think the idea that the two parties are going to reach across the aisle and get some kind of tax and spending package just strikes me as optimistic.